If there's ever a time when I don't know what side of the marketplace I want to focus on, in other words, I'm waiting for more information, submitting to the first half an hour of the opening range, looking for first percent to fair value gap, looking for the market to consume 9:45 or 10 o'clock news. If I'm just really reluctant to do anything until the first hour is trading, then it's usually going to be as a result of a market that just completely rips off into one direction, basically today. Okay, so with that, I highlighted the low and the highest high inside the first hour's trading. So at 10:30, go back to 9:30, mark out the highest high and the lowest low. Okay, and by having that range, what you can do is you obviously have to grade it because all of your key PD arrays are going to form around in close proximity to one of these gradient levels. And I want to take your attention up into the upper half. So here's that 50% level. Okay, so this first hour's range, the upper half, it's going to be sensitive if it's bullish. Okay, so then I want to focus on that, not worrying about the lower half. So now what I've done is zoomed in to the upper half, and that's all that is. Okay, now right away, you can see there's a quadrant level here. There's or not a quadrant level, a gradient level here, gradient level here, gradient level here. And we trade almost to this high here, but then we break that low. So this is the next one it's going to trade to. Now in this level here, look just above it. There's a small little gap there, but there's a swing low right there on that level. So go past that to the left. What do you have? Inefficiency. Okay. So you can see right away that that is a valuable candidate, potential candidate for a high probability discount PD array in the form of a buy side imbalance, sell side inefficiency, or BISI. And the market trades down to consequent encroachment. Look at the bodies staying in the upper half. The market rallies up, comes back down, touches the gradient level, rallies up, drops back down in, trades higher, and eventually takes out the buy side above these relative equal highs. Now, that sounds great, right? Hindsight, anybody can do that part, right? So what I want to show you now is I'm going to take off that blue box, and I want you to think about what you see here. What do you see right there? Market maker buy model. Zoomed in, original consolidation, first stage distribution, second stage distribution, down right into that discount buy side balance, sell side efficiency. Rallies up. There is a conversion fair value gap here. Extend that forward. You can see that right in here. There's accumulation. Second stage reaccumulation, but in the upper half, from this high down to that low, it's still trading at equilibrium. It trades down into that and then rips higher, attacking that buy side. Notice the bodies here. See how they're all more or less converging around the same level? Disregard that wick. I just had that as the highest high at the time. Then I thought that they were going to run just these bodies here, and you'll see that I did some executions here. So we have a inversion fair value gap there, trades up. I was watching to see if it was going to use that. It did, went below it, changed the state of delivery, which are these three up close candles. That's my bearish order block. It's the opening price right there. Trades up into it, hits it. Very quick market, hits it and pulls away. I end up getting in as it's pulling away from it. Got a little bit of slippage there. You can see the prices, by the way. And then I added more to it there. And then added to it again in here. And then once more when we were trading back up into it there. And then ultimately filled out right on the consequent encouragement level right there. Now notice at the bottom of the chart, this is not market replay. I didn't have a chance to record anything today. My attention was divided between what my puppies were doing, what my wife was talking to me about, and doing this as well. So the recording wasn't possible. And the idea of trading down into that level there, and then I wanted to see, does it repel price there? Do this inefficiency here on a 1 minute chart for March delivery. Get the consequent encouragement level, and you'll see it trades right to there. And my exit price is right to the tick on the consequent encroachment level. That's what that price is. So it was just simply a limit order. I did fancy dance it, trying to be cute with it, but I could have been snuffed and not allowed to get out of it, and then it would have completely reversed on me. So if that would have happened, you would have saw that, I would have been stopped out up here, which you've seen executions do that sometimes with me. And I went long, and now I'm using the market maker buy model. So I went long here and then rallied up, traded down, had to take a little bit of heat against the position. The original stop has to be below that low right there. So buying here, stop loss down there. It's a little, it's a little wider than you're probably used to because you want like really, really small stop losses. And they're kind of hard to pull off right now with the level of volatility you have. Like lots of back and forth, sharing the previous candles ranges. It's a little bit more difficult. If you think it's easy, then maybe you should do a mentorship, and I'll sign up with your stuff. You think I'm really going to do that? I'm not. So the point is going long in here, absorbing all that, and then waiting for it to rip above these bodies here. Okay, so that is this. You can see that's where my exit was.